Good afternoon, distinguished ladies and gentlemen. It's my pleasure to welcome you to this Zoom webinar being organized by the Risk Management Academy Limited. My name's Dr. Emmanuel Abolo. I am the Group Managing Director and Chief Executive of the Academy. Our focus is on training professionals on risk management, governance, and compliance. We also run an institute which is known as the Institute for Governance, Risk Management, and Compliance Professionals. Now, this afternoon, we are going to be talking about a very important subject, and that is the issue of liquidity optimization. And this subject is going to be discussed within the framework and context of the Basel Free Accord. So once again, you're welcome to the webinar by the Risk Management Academy. Now, we want to quickly recollect that the global financial crisis, which began in 2007 and ended in 2009, 2010, highlighted the major, shortcomings and issues with the framework that was crafted under the now known Basel II Capital Accord. You will recollect that the Basel II Capital Accord focuses around minimum capital requirements under the Pillar 1, and we are going to talk about this much later. But this new accord, the Basel III Accord, came on stream to handle more robustly the issue of minimum capital and with very intense focus on liquidity requirements. And so the Basel Committee of Banking Supervision, BCBS, made substantial revisions of its guidelines under the Basel II Capital Accord. And now the framework has now come on stream and is being implemented across the globe. Now, the main objectives of the Basel III Capital Accord are three. One is to improve the banking sector's ability to absorb shocks arising from financial and economic stress, or what you might also refer to as exacerbations, whatever the source. The second objective is to improve risk management and governance, and finally, to strengthen banks' transparency and disclosures. Transparency and disclosures refer to the Pillar 3, component of the Basel III Capital Accord. Now, this is a picture showing the Basel III at a glance. You will find that the same three pillars under the Basel II Accord has been retained. But what has changed really is that for each of the pillars, there are substantial enhancements. And so you will see enhanced minimum capital and liquidity requirements under Pillar 1, enhanced supervisory review process for firm-wide risk management and capital planning, what you might also refer to as ICAP, internal capital adequacy and assessment process. And then, of course, Pillar 3, which has to do with risk disclosure and market discipline. That is the issue of transparency. So this is the Basel III at a glance. We can further break this down or calibrate in order to see what the details are. But don't forget, we are focusing mainly on the issue of liquidity optimization. And so our attention should really focus on what is happening under Pillar 1, which is the minimum capital requirements. You will find there that there are additional refined capital bases. You find that liquidity coverage ratio, net stable funding ratio are extremely new addition to the Basel Accord. Issues of OTC derivatives charge, quality and level of capital being enhanced. The leverage ratio is a new one. The capital conservation buffers is a new one. Counter-cyclical buffers is also a new one, and so on and so forth. So let's look at it in the next slide. you will find the difference between the Basel II and the Basel III capital accords. The first is the capital conservation buffers to risk-weighted assets. You find that that was not in existence under the Basel II Accord. Now, that ratio is put at 2.5%. The minimum capital ratio, which is a proportion of a bank's risk-weighted assets, used to be 8%. That has been increased to 10.5%. The minimum ratio of common equity to risk-weighted assets has also increased from 2% to 4.5%. The Tier 1 capital to risk-weighted asset has been moved also from 4% to 6%. Now, the leverage ratio was not in existence under the Basel II Accord. Now it has been introduced and is put at 3%. What of the leverage ratio for systematically important financial institutions, the SIFIs? It was not there under Basel II, now it is 8%. The issue of countercyclical buffer has been increased. It's now 2.5%. It was not there under the Basel II. The liquidity coverage ratio was not under Basel II. Now it has been brought in under Basel III, and the ratio should exceed 100%. Then the net stable funding ratio was not there also under the Basel II Accord. Now it has also been introduced, and that ratio should be greater than 1%. So in a nutshell, there has been substantial enhancement to the Basel II Accord under the Basel III Accord. But don't keep your eye off the ball. We are focusing on the issue of liquidity optimization. Now, so what has happened is that the Basel Accord allows for national banking authorities, the regulators, to implement the Basel Accord, taking cognizance of their own peculiarities. In other words, it is not a case of a broad brush. No one size fits all. And so the Basel III introduced two required liquidity ratios, as we mentioned before. The first is the liquidity coverage ratio, which is calculated as the ratio of your total stock of high quality liquid assets, to total net cash outflows over the next 30 calendar days. Like I said before, this has to be greater than 100%. And then the second component of the liquidity ratio is that of the net stable funding ratio, which is the ratio of available the ratio of the available amount of stable funding. Take note, available amount of stable funding as a proportion of required amount of stable funding. The numerator is the available amount. The denominator is the required amount. Then that ratio, fund is funding over a 1-year period of extended stress environment. So these are the two key ratios that are meant to deal with the issue of liquidity. So what has then happened is that many bank officials are asking questions, because the Basel III Accord poses certain challenges, and that has made them to be asking a couple of questions. The first question is, how would they be able to optimize the amount of liquidity that they need to maintain? And that question is very important, because there is an inverse relationship between liquidity and profitability of an organization. So they are raising that question: how can they optimize the amount of liquidity that they need to maintain? The second key issue is, how do market factors, and stress events impact their liquidity ratios? Third, how does their liquidity strategy affect the liquidity ratios, and how can their liquidity ratios look quarter by quarter for the next 3 years, for instance? And how can bank, as it were, or financial institutions prove or demonstrate to regulators that their balance sheet is robust enough to be able to manage exogenous factors? And finally, is how can they improve their profitability and rate of return without affecting their liquidity and their compliance needs. So these are very key questions that the Basel III has thrown before officials of banks. So how will they be able to deal with these issues? Now, managing liquidity in a complex web of interactions can be very, very challenging. Essentially, managing liquidity and optimizing liquidity for a bank requires that they focus on three main areas. The first is funding liquidity risk. The second is market liquidity of assets. And the third focus is liquidity management, intraday. But in trying to deal with these three areas, there are certain metrics, measures that every bank needs to keep track on. For the funding liquidity risk, the issue is the metric to be used is the liquidity coverage ratio and the net stable funding ratio as specified under the Basel III Capital Accord. For market liquidity of assets, banks need to use metrics such as bid-ask spread, and then of course liquidity index, which is based on traded volumes. And for liquidity management intraday, banks can use this metric, that is the daily minimum liquidity requirement, as well as total payments. Now, carefully balancing, managing this, optimizing liquidity within these three areas and using these metrics requires, an act of delicate, balancing and complex, web of interactions. This involves balance sheet analysis, factoring, and this deals with the issue of steady state stress scenarios and behavioral aspects. That means banks must have the capacity to conduct robust stress testing and robust analysis to be able to determine areas where risks are coming from to be able to optimize their liquidity. They also need to conduct cash flow analysis in terms of deposits and other liabilities. And then, of course, cash flow analysis that cover assets, and then cash flows that deal with the issue of off-balance sheet items. So managing liquidity under the Basel III can be quite complex, but it's doable. Now, so what are the keys to liquidity optimization? As you can see from this picture, it's a three-step process. It's a three-step process involving visibility, control, and optimization. In terms of visibility, it deals with the issue of cash positions, which allows for the efficient management of funding and investment needs. For control, is talking about access to cash flows and balances, and then the optimization process has to do with opportunities to leverage tactics that will optimize the yields on balances depending on the amount, currency, duration, and location. So following this three-step process, any bank can actually optimize liquidity management in their respective institutions. So how can Treasury optimize liquidity and funding? But of course, our focus is not on funding issue, but on liquidity. But you cannot really separate liquidity from the issue of funding. Now, the major goals of the Treasury needs to achieve are four. One, to minimize funding excess, to ensure that the Treasury has access to the data required to optimize funding strategy, to optimize the operating model for repo funding, and then, of course, to optimize the size of the liquidity pool. Now, in achieving these clear goals, the Treasury needs to respect few golden rules. The golden rules are three. One, you need to optimize intercompany funding to reduce external funding. Number two, you need data structure that is consistent across the front office, the middle office, the back office. And the third golden rule is that repo transactions need to be used to optimize cash management and fill liquidity gap. So it is this golden rules that has been cascaded, down in this diagram. You'll find minimizing funding excess, ensuring access to data, optimize report funding, and optimize liquidity pool. We are going to focus on the fourth column, but it is important for me to state at this point that access to data is very key in managing liquidity and optimizing liquidity. Data structure should be consistent across the front office, the middle office, and also the back office. Again, market data should be available to Treasury in order to make the proper liquidity risk analysis and decisions. So Bloomberg and other access to information and data is very key. And of course, a structured reporting process should ensure the possibility to roll up and roll down information without discrepancies among different reporting layers and mechanisms. So now let's take our attention to the fourth column, which is the issue of optimizing liquidity pool. What is required here is that high liquid assets need to cover expected and unexpected cash outflow in the upcoming 30 days. Second, liquidity buffer need to be essentially kept between 1 and 1.5 times the mandatory buffer. Number 3, liquidity check needs to be performed at least 3 times per day, and that is best practice across the globe. And finally, that a liquidity contingency plan needs to be structured and calibrated. So, to be able to optimize, to handle all the issues we have discussed requires, a solution, technology platform to be able to uniquely be able to integrate liquidity risk management into the operations of the bank. Because meeting the Basel III liquidity requirements and to drive business growth can be quite challenging, but like I said, it's doable. So any solution that the bank must deploy must be able to empower it to meet both liquidity needs and the minimum standards of the Basel compliance. Number 2, the solution should be able to effectively allocate and use capital and funding, and to be able to better execute investment and revenue growth strategies. And finally, any solution deployed must go a step beyond just meeting the Basel III liquidity requirements. The point is that implementing the Basel III framework should not be seen just essentially from compliance mentality. There is a strong business case for the Basel III Capital Accord, and therefore banks need to even go beyond meeting the Basel III liquidity requirements. So that essentially is a summary of how to optimize liquidity under the Basel III framework. Now, the question is, if you have thoroughly enjoyed this presentation, and I know you do, you will be asking, how do you continue with this engagement? So I would say that if you desire online virtual training for your team or organization, we can discuss, we can work this out, and our prices and fees are affordable and reasonable. Our training hours also are tailored to fit your specific and peculiar requirements to needs. So those are our contact details, and we look forward to hearing from you very, very shortly. I want to thank you very much for attending this webinar on optimizing liquidity under the Basel III Capital Accord. So the Risk Management Academy wishes to thank you very much. Those are our phone numbers, our email are also indicated there. We focus on training, and we're certified by the CPD certification group of London. Let's take care of all your risk needs. Thank you very much, and welcome to the webinar. We look forward to seeing you next time. Thank you. Thank you very much.